Hello, this is Alex from Sharpe Two, and today we are going to see how you can dive deeper into our research, but in total autonomy in self-service mode. So without further ado, let's have a look at it. When you land onto the platform, the research section does most of the heavy lifting for you. In the VRP section, for instance, our ML models are scoring variance harvesting opportunities that deserve your attention. So for instance, SMH or XLB at the moment, if you're trying to stay away from the precious sector metal that is a little bit crazy at the moment, those seems to be great opportunity to consider. But that is not all. We also have a long short section where you can look for opportunities where implied volatility of one ticker against another might be a little bit overstretched, will converge back to one another. So you could filter there by Z-score and identify a situation where, for instance, ARM and AMD are quite far from one another. Again, from an implied volatility perspective, it's not a traditional per trade. In the vol dislocation tab, you will find places where our analytics and our models, the vol surface is quite dislocated, distorted, and our system are pointing you trades where you are essentially betting on the normalization of that vol surface. It's great, but what if you want to do all of this stuff by yourself in total autonomy? Because, for instance, one of the ticker you're looking for is not directly flagged by our model or doesn't present a special situation. Well, for that, you can use the analysis section where you will be able to design exactly the analysis you're looking for. So there we are. When you start an analysis from scratch, you will have to follow these 3 steps, pretty logical. The first one is what type of strategy you're looking for. So once again, the 3 area where Sharpe to deliver value is VRP harvesting through our machine learning models, long short situation where one ticker against another, their implied volatility are most likely dislocated, or an actual vol surface dislocation. Because at the moment things are a little bit crazy into gold. Let's say that we want to pay attention to that one. You then have to pick the date that you're looking for. Let's take the date of yesterday, for instance. And because it's forward vol analytics, right, you will have to pick the 2 different slices that are of interest for you. So let's say something that looks like a month forward volatility. All you have to do at that stage is really hit confirm charts, and all the analytics are going to show up for you. And it's time for you to make your analysis, your conclusion. Pay attention to the little details that ultimately will help you structure a trade. So for instance, there's a famous strategy that compares spot vol against forward vol, and if your spread between the two is way too high, you may be considering shorting the spot vol and then buying the forward vol, so through calendar spreads. Overall, it's great to get a feel for what's been happening. So talking about precious metals being a little bit crazy, I think we tweeted about that this week. It's quite rare to see implied volatility just going up non-stop and taking really no prisoners. That forward vol premium is what we're describing here. It's the difference between the spot vol and the forward vol. And as you can see, indeed, for that specific slice between 28 and 61 days. So basically, we compare spot vol at 28 days against the forward slice that comes right after. The premium is collapsing, meaning that implied vol versus the spot vol is much, much higher. So the market is anticipating something crazy within the next 28 days, but then not something, still something crazy, right? When you look at that slice, you still expect something quite significant to happen. 27 forward vol is not nothing, but we're essentially saying there might be a bit of a disconnect right now between the spot and the forward slice that comes right after it. So you may want to be willing to sell the spot and then buy the forward slide after that. Same idea with long short. Let's have a look at what it looks like. We're gonna have to pick the date of yesterday and then ultimately 2 tickers that are of interest. So let's do Goldman Sachs and JP Morgan. Obviously, you don't need to pick an horizon because it's a long short signal. And then same idea, you will have that nice and neat dashboard that allows you to look at things the way you want to. If you want to compare over time how the two uh, implied volatility for both tickers look like, you can have a look at it through a line, potentially through a scatter. It's pretty consistent over the years, but sometimes you have situation where actually we have one right now where the residual between the two is slightly out of sync, right? When you do Z-score it, you end up seeing that at the moment it's -1. So it's not as crazy as it was about 2 weeks ago. That makes sense. This is the kind of trade that you want to pay attention to around earnings, because the market tend to beat the implied volatility of one before the earnings, and then the situation tend to resolve right after it. The methodology is pretty simple. We have multiple articles talking about this, but we do compute the correlation between the two implied volatility. We make sure that it's stable over time. You have some pair of tickers where it's not that stable, and it's probably not recommended to do it on those pairs. But overall, two companies that have similar profile, they work in the same industry, their volatility should behave the same way. You can start to dig deeper into finding these kind of opportunities. In another video, we'll talk specifically about how to trade signals like this one. It's very important to be vega neutral. So if you never really thought about those concepts, stay tuned. Comfortable, then I think that that view brings a lot of value to you. Finally, the VRP page, although I'm pretty sure that most of you have seen it so far, but let's have a look. You can pick an horizon, 9DT or 30DT. And this is where you'll find machine learning models, scoring, the harvesting opportunities on the variance side of things for the different tickers that you're looking into. Apple was supposed to report earnings, so obviously the VRP was higher side. The main key drivers here that the machine learning models were pointing to was the fact that the VRP at 1 month is actually a little bit stretched, not the stretchest ever, but still something that deserves paying attention to. If you were interested to look into shorter time frames, you would still find a prediction that we make, and then a lot more drivers in the case of Apple. Once you're here, you don't have to create a new analysis all the time. You can just go switch tickers and look for the one you're willing to explore. That's another good one. On the short-term side of things at the moment, TLT looks like there's a decent bit of edge, a little bit less edge at 30 days, but at the end of the day, you want to compare these two and then structure a trade the way you want. That is it for this video about how to use the analysis sections to dig deeper into things on your own in full self-service, full autonomy. Sometimes that's all we want, just take our time and have fun with the data. I hope you will find that feature useful. The pre-built dashboard, as far as I'm concerned, I think they're great. They're pretty informative. If you want to see more data, more analytics, if there is something you think is missing, if there is a piece of insight that we should add, please let me know in the comments. Hit me up on Substack or in the Discord, and I will look into it. Obviously, the platform is evolving every single day, so do not hesitate. In the meantime, happy trading.